Hello, thanks for joining. For those of you who do not know me, my name is Luke Yengo, and I am a financial planner within Continuum Consulting Group, boutique wealth management firm here in beautiful Irvine, California. And for clients on the call today, thank you very much for being here. It should be somewhat of a refresher from much of what we've discussed in our planning meetings. However, it's always a good idea to review. Before jumping into today's content, I do want to mention that we're going to be reviewing some tax strategies, as the webinar title suggests, and it's always a good idea to review those with a qualified CPA or tax advisor to ensure that they are correct for your situation. But to give you some background on us, we're a boutique wealth management firm, financial planning firm here in Irvine, California. However, we do have clients across the majority of the states. And what we do with our clients is we work with them on their holistic financial planning and investment management needs. I found that our industry is just too focused on just the investment side of planning. So we've made it a priority to take both a comprehensive and holistic approach to planning and to continuously educate, which is one of the reasons why we host this webinar series. Now, our process involves taking our clients through well-designed financial plans, organizing our clients' investments in coordination with that planning, and then to ensure that really any outside financial planning items have been taken care of. And here's a quick overview of our team. Within the firm, we have 7 planners, a retirement plan specialist, an investment specialist, and then 3 administrative assistants. But enough about us, let's get into today's topic. And I always like to start these webinars by explaining that true planning involves an array of varied topics. As you can see here by this planning pyramid, it's not just in the investment component. But for today's conversation, we're most likely going to be focused on the task aspect. And throughout this series, we're going to be getting into much of this pyramid so you can better plan for your own financial well-being. And for today's agenda, we're going to be focusing on a few strategies that can assist you in improving your long-term rate of return through proper management of your accounts. And the first we want to discuss are Roth conversions, and then get into a very unique strategy called a backdoor Roth IRA. Next, we'll review spousal IRAs and strategies associated with them. I'll close out the conversion with some tax-efficient investment strategies. And the reason we built this and designed this webinar is because, quite frankly, taxes are a lot. 37% is the highest federal tax rate, with 12.3% being the highest state rate in California, where our firm is. Not to mention a 7.65% payroll tax for W-2 employees, or a 15.3% payroll tax for those that are self-employed, like many of our clients. But even outside of the taxes you see on your pay stub, you have sales tax, the estate tax, capital gains tax, property tax, and more. There are many ways in which the government taxes and charges us. And while it is a necessity, because we do get a lot from our government, there's no reason that we can't implement strategies that help to lower our tax bill. And there are many strategies that one could implement. And typically, to know what's best for you and your situation, you do need to have one-on-one time with a financial planner or a CPA. However, what I want to do today is to share some of the strategies that I use on a day-to-day basis with my clients. So you are all aware of some of the alternative methods to save in tax beyond just, making 401k contributions, for example. So let's just jump right into it with some of the strategies available within your retirement accounts, specifically Roth-based retirement accounts. So I first want to talk about Roth conversions. This is a very underutilized strategy, but when done correctly and consistently, it can save thousands of dollars, sometimes even a lot more in taxes, and can help your portfolio continue to grow and build throughout retirement. But before getting into the details of the strategy, let's quickly review the difference between a traditional IRA and a Roth IRA. Because if you don't know that, then this strategy is just not going to make any sense. And with a traditional IRA, you put pre-tax dollars into an account. You receive a tax deduction the year that you contribute to the account, then you invest within the account. And then at retirement, when you pull the money out, it's taxed at really whatever tax bracket you are in at that time, because every dollar taken out of an IRA is considered income. Now, a Roth IRA is essentially the opposite. You invest post-tax dollars, receive no tax deduction. You invest that money, and you allow it to grow. And then at retirement, you pay no tax on the distributions so long as it's a qualified distribution, meaning you've held the account for over 5 years and you withdrew after age 59 and a half. Now, There are limitations to who can invest in what, but for now, that's really not too important. All you really need to know is that when you're a high income earner and your tax rate is high, typically you invest in a traditional IRA. When you're in a low income bracket and you're a low income earner, you generally invest in a Roth IRA. But what many people don't know is that you can actually move money from a traditional IRA into a Roth IRA at any point, and that's what's called a Roth conversion. And what's unique to these conversions is there's actually no income or contribution limits associated with the strategy. So, in the simplest terms I can put it, a Roth conversion just involves having money in a traditional IRA. Next, you move a specific dollar amount from the traditional IRA into the Roth IRA, and the amount that you move over is then included in your taxable income for that year. So you're going to pay taxes on it. From there, those assets are now in a Roth retirement vehicle, so the investments grow to completely tax-free. Now, what you may be asking yourself, though, is why convert from a traditional account to a Roth account if the whole point of investing in the traditional IRA was to hold off on taxes? Well, the answer is easy. Some years you may make a lot of money. And during those years, you want that tax deduction, so you contribute to a traditional IRA or a traditional 401k, for example. However, other years you may be in a low tax bracket, and it may actually make a lot of sense for you to strategically move money into the Roth account to purposefully, the key word here, purposefully pay lower taxes on it and let that grow tax free. For example, let's say you've been making $300,000 a year, and then one year you decide to take off work for whatever reason. Well, during that low income producing year, when you're not working, your income tax bracket is essentially nothing. And rather than just not paying taxes, you could strategically, in this example, convert some of the money from your pre-tax retirement accounts into a post-tax account. So let me show you a very simplified example to help explain. And let's say the hypothetical individual we're talking about is Joe. Joe is 60 years old. He's retired and has $30,000 in an IRA. And he leaves that money alone for 10 years, and it doubles to the value of $60,000. And at age 70, let's say Joe decides to take that money out and buy a new car. Well, at age 70, Joe may have some Social Security income, he might have a pension, and then now this IRA distribution, which all counts towards his income. So let's just say, for this example, Joe is in the effective tax rate of 30% at age 70. Well, now all of those IRA funds are going to be subject to 30% taxes, yielding a true distribution of $42,000 after Joe pays the tax. So as you can see, the true value of Joe's IRA, it wasn't $60,000. It was much less because taxes still needed to be assessed. Now instead, let's say Joe at age 60 decided to convert those dollars because he thought to himself, hey, I'm in a low tax bracket, may as well just get this over now. And because of that, he converts the $30,000, and for this illustration, let's just say he's in the 15% effective tax rate. And at that time, he's going to pay some of the taxes using the money he converted. Now his account's going to be $25,500, and then it doubles once again over 10 years, just like the previous example. The only difference now is at age 70, that $51,000 in his account is truly worth $51,000 rather than $42,000 in the previous example. And it's truly worth $51K because there are no more taxes to pay in this situation, so long as, of course, he makes a qualified distribution. So as you can see in this example, Joe, he actually improved his financial position by strategically paying retirement account taxes in years that his tax income liability was low. But what I've talked about here, this is just a one-off tactical conversion. It may be applicable to you, but there's also a way to do this on an ongoing basis to potentially save even more for retirement. And essentially what this strategy is upon retirement, and for this strategy to work, the earlier you retire, in most cases, the better, you'll want to first maintain a low tax liability as best as possible. Now, this is going to involve three things. First, pay your bills. When you pay your bills, you're going to want to strategically pull money from non-retirement investment accounts to avoid capital gains, which increase your income level. Secondly, you'll want to hold off on taking Social Security and other pension benefits unless, of course, if the benefit doesn't increase the longer you wait to claim it. For example, age 70 is the very latest you should wait to claim Social Security because after 70, you don't get any increases. And lastly, you'll want to implement tax-efficient investment strategies, which will ultimately lower your tax bill even more. We're going to talk about this at the end of the webinar as well, so hold tight. Now, while maintaining a low tax bracket over the years, you'll want to exercise these Roth conversions on a yearly basis strategically. And you'll want to determine the exact dollar amount to convert at the end of the year, usually in December. Next, generally speaking, if you can, you're going to want to pay taxes with outside money, not the IRA money that you're converting, like in the previous example. Doing this will potentially allow you to pay taxes while you're in a lower tax bracket and let those Roth retirement dollars continue to grow. And why I say to pay the taxes with outside money and not to withhold taxes from the conversion is because doing so essentially allows you to contribute additional money to your retirement accounts, even when you may not be allowed to do so. For example, by converting, let's say, I'll keep the number simple, $10,000 of an IRA account into a Roth account, and then you pay the tax with outside money, you're moving 10K of pre-tax into an account that's post-tax. Essentially, what you've done in this scenario is you've increased the true value of that IRA, just like what we talked about a few slides earlier. Because as we all know, 10,000 in a Roth account is almost always worth more than $10,000 in a traditional account. But the one nuance with this is when you do large conversions and you have a large tax liability, you might need to pay estimated taxes. So make sure to talk to a CPA or an advisor in regard to the strategy. Don't just wing it. No one wants to get hit with a large fee. But I'll leave it at that in regard to the strategy, and I'll move on to the next. And the next strategy is called a backdoor Roth IRA. And what this is essentially a Roth conversion, just like we've discussed. But instead of it coming from a traditional pre-tax IRA account, it's coming from a non-deductible IRA. And all a non-deductible IRA is an individual retirement account where you contributed money to it, but you weren't able to receive the tax deduction. And this is generally due to an individual's tax bracket being too high to make the deduction, which we'll discuss shortly. But when done correctly, a backdoor Roth IRA is essentially a legal loophole for high wage earners to contribute to a Roth IRA when they wouldn't necessarily be allowed to do so because of their income tax bracket. And the reason you would want to do this is if, let's just say, you're making a lot of money, you've already maxed out your 401k, but you still have some more money to invest. And because of their income levels, they're unable to invest in the traditional IRA and to continue to receive a deduction. And they're also unable to invest directly in a Roth IRA. And that is when the strategy comes into play. It's very rare that this is applicable to you, but if it is, listen up. So as you can see here, highlighted in yellow, these are numerous situations where one may not be able to receive a deduction by contributing to an IRA. I have a client, for example, who's very young and makes a lot of money. He maxes his 401k plan out every single year, but he has a lot of excess, so he also invests in outside investment accounts. And rather than just investing all of his excess into a taxable brokerage account, we follow this backdoor Roth IRA strategy. So let me explain this in a little more detail. And to go back to the previous slide, essentially what you do is a two-step process. First, contribute to a non-deductible IRA, which is just an IRA where you don't report the deduction to the IRS. You don't decide this though, the IRS decides this. But the moment those funds are within an account that was non-deductible and the funds are available to trade, you then would convert that cash into a Roth IRA account via a Roth conversion, just like we talked about. The only difference now from what we talked about a minute ago is that none of the proceeds from the conversion, when done correctly, which we'll discuss, would not be subject to tax because you've already paid the taxes on them since there was never a deduction, hence the name non-deductible IRA. So essentially what you've done is you've moved money from an IRA that was a non-deductible account to a Roth IRA at no tax cost. Now this is just for illustration purposes, but the power of tax-free growth is real. In a taxable account, your account value continuously is lowered through ongoing taxes. And in a traditional IRA, eventually you have to pay income tax on the holdings. But with a Roth IRA, as long as you make a qualified distribution, which occurs after the age of 59 and a half, and you've held that account for over 5 years, everything is going to be tax-free. So if you had, for example, $6,500 and you can't deduct the contributions of a traditional IRA contribution, and you don't have any more 401k contributions for the year, then doing this backdoor Roth IRA may make a lot of sense. And this may sound good, too good to be true. And for some, quite frankly, it is. So let me explain the reason why this is not for everyone. And the reason is the pro rata taxation rule. And essentially what this means is when you attempt to convert IRA dollars to a Roth, you don't get to specifically pick and choose the non-deductible funds to convert. It's proportional based off of all the traditional IRA and all the non-deductible IRA dollars that you have throughout your portfolio. So if, for example, you tried to convert $6,000 of a non-deductible IRA contribution into a Roth account, but you also had $12,000 of regular IRA contributions that did receive that tax deduction, then only 1/3 of that Roth conversion would be tax-free. 2/3 would be subject to the income taxes of a Roth conversion. So then who are these backdoor Roth IRAs good for then? Well, simply put, they're good for non-working spouses who don't have a retirement plan through work, which we'll talk about shortly, or those that have little to no money in a traditional IRA account held within their portfolio. The client I told you about is a very good example because he's young, he makes a lot of money, he maxes his 401k. However, he has never rolled out any 401k money into an IRA, and he's never made a deductible IRA contribution. So all of his 401k holdings do not count towards the pro rata rule. I hope this makes sense. Like I said, I will be opening it up to questions at the end. So feel free to mark down anything you may want answered, and I'll be sure to get to it. But I do have two more IRA strategies before we get into tax efficient investing. And the first strategy is a spousal IRA. Now I'm going to be changing gears here a bit, but I'm about to bring it full circle. And what this strategy is it gives non-working spouses the option to contribute to a retirement account, even if they have no income. As you can see, if you're married filing jointly, you make less than $218,000 a year, and one spouse is not covered by an employer plan, then that non-covered spouse can contribute to an IRA and potentially can receive that tax deduction. So this would be great for a couple where one spouse is the breadwinner, they already max out their 401k, but they do have that excess income and they have excess to invest. And they invest it in an efficient manner by investing through a spousal IRA. And as long as they're under that $218,000 income mark, they're going to receive the tax deduction. So it's a pretty fairly easy strategy. It's really just being aware of the strategy. But what would you do then if you were above that income level that disqualified you for the deduction? Well, let's combine these strategies again. Now let's utilize a spousal non-deductible contribution along with the backdoor Roth IRA. Once again, if you're unable to receive that deduction, it may not make sense to contribute to a non-deductible IRA and then to convert those. If you're not able to receive the deduction, it may make sense to contribute to a non-deductible IRA, but then just convert those dollars immediately to a Roth account. The strategy is perfect for individuals who are homemakers, may not have ever had a traditional IRA, or may not have a 401k, but they have other sources of income that would allow them to put money into this tax efficient investment vehicle. And not only is it a good strategy, but when it's done regularly, it could make a huge difference in retirement savings. For example, if you implement something like this strategically for an ongoing time frame, you'll begin to see significant growth, but just as importantly, growth in a tax efficient manner possible. I always like to say, it's not about how much you make. It's not your ROR, your return on ROI, return on investments. It's about how much money you make through your investments, but also how much money you keep in your pocket through tax savings. So I'll leave it at that with those specific IRA strategies, and I'm going to quickly go over a few points to note regarding IRAs. First off, for those over the age of 50, you can invest an additional $1,000 into an IRA as a catch-up provision. This essentially allows older individuals the opportunity to save for retirement. Second, IRA contributions can be reversed during the calendar year in case you prematurely executed a strategy that wasn't correct for your situation during that given year. And lastly, I wouldn't be doing you justice without saying that proper accounting is key. The government is not going to keep track of all this information for you. It's your responsibility to properly account for the specifics, like a non-deductible IRA versus a deductible IRA, and then to file the proper forms when implementing strategies that require filing. And additionally, and this was reported in 2023, The contribution limit is $6,500 for those under the age of 50. Once you reach 50, you have to catch up $1,000, so $7,500. So just know that those were increased from the previous year of 2022. But to summarize everything, these are very proactive and strategic strategies that can help you and your family properly save for retirement. They may not be applicable to you now, but talking with your advisor about these strategies and ensuring that you're doing all for your situation is key to building a proper financial foundation that will set you up for retirement. But enough about IRAs. Let's talk about tax-efficient investments. And the thing I want to explain is the tax difference between non-retirement investment accounts and retirement investment accounts. Essentially, retirement accounts have this tax bubble around it. And no matter what you do within the retirement account, you're not exposed to any taxes until you withdraw the money. Or in the case of a Roth IRA, you're never assessed taxes when you make a qualified distribution, as I mentioned earlier. So if you sell a stock at a gain and buy something else, there's no tax. If you receive a dividend from a stock, no tax. Gains associated with yearly mutual fund distributions, no taxed. See where I'm getting with this? You're essentially protected from taxes in a retirement account until you distribute, and everything just stays in that bubble. That significantly allows your assets to continue to grow, and that's why we always recommend, if you can, invest your money within retirement accounts, especially when investing for long-term wealth long-term wealth and retirement planning. But with a non-retirement investment account, however, these specifics to the tax, they're just not the same. All those situations I just explained would subject you to tax and would ultimately lower your cash flow. And because of this, it's important that you properly manage these taxable accounts for tax efficiency. So what does this all mean? Well, what it means is that your non-retirement investment accounts should probably have different things in them within them to avoid taxes and should be managed slightly differently. For example, you probably shouldn't do a lot of active trading in a non-retirement account. Your long-term assets should be held here, and as much as possible, you should avoid selling them at a gain, which ultimately exposes you to the capital gains tax. Secondly, if you have bonds in a taxable account, you may want to consider state-specific municipal bonds. These are tax-free on a state level and in most cases on a federal level as well. Additionally, you'll want to invest in index-based mutual funds and ETFs rather than actively managed funds. The reason that a mutual fund, or the reason for this is that mutual funds and ETFs typically buy and sell securities throughout the year internally within the fund. And any gain within the fund is then usually pushed off to the investor at the end of the year via a 1099 statement. So you may have never done any trading within that taxable account during the year, but if you have mutual funds, you're most likely going to have some income to report. And the benefit of indexed mutual funds and ETFs is that they typically have lower trading volumes within the fund itself, which means less potential for a gain on your end. Now, everything I just said is specific to non-retirement accounts and not applicable to retirement accounts necessarily. So if you want to invest in high-yielding corporate bonds, actively managed mutual funds, and potentially want to invest in short-term assets, please do so by all means, but consider buying them within a retirement account because you have that tax protection there. That is what's called asset placement, which is drastically different than asset allocation. But in many years, even with these strategies, you are going to have some taxes to pay. And ultimately, you will pay taxes on gains within your taxable accounts. So how can you avoid that? Well, there's no surefire solution. However, there is one strategy that you can implement within your taxable accounts on an ongoing basis, which will help to lower taxes year to year. And that's called tax loss harvesting. And many of you may be aware of this strategy, but not necessarily the specifics. So I'll dive into that now. And what this strategy is really a way to sell securities at a loss on purpose to receive a capital loss, which ultimately offsets capital gains and potentially earned income. And at a high level, what you do is you sell securities that are at a loss in a non-retirement investment account. And when you sell them at a loss, you have what's called a capital loss. And you can do three things with a capital loss. The first, and you have to do these in order, the first is you can offset capital gains for that current year, which remember, capital gains are taxable, so you're saving a little bit in tax. Second, if you don't have any gains to offset or you've already offset all the gains, You can then offset up to $3,000 of non-investment income, basically a tax deduction of $3,000. And the third thing is once you've already done 1 and 2, offset gains and offset up to $3,000 of income, then you can carry forward any additional losses to the next year and to repeat the steps that I just mentioned to ultimately lower your tax bill in years to come. Now, you may be asking yourself, why would I want to sell assets at a loss? My advisor has always told me stick to our strategy, stay invested. Well, that is correct in the sense that you should stick to a strategy, but not necessarily that you should just hold on to all your assets. Because when the strategy is done correct, you can essentially maintain your current portfolio almost exactly how it is, but also tack on capital losses to help your tax bill. Let me explain though. Let's just say you own a Fidelity International stock fund, and the fund is currently at a loss in your portfolio. And by the way, I'm not advocating for Fidelity. This is just one example of a mutual fund manager. But let's say you sold the fund, you captured the loss, and then you purchased the fund back the very next day to maintain your portfolio allocation. That would actually not be allowed. That's what's called a wash sale. And the reason it's a wash sale is because you sold it and then immediately bought back something that's identical. You can't do that. You have to wait at least 30 days to buy back that fund or that stock or that bond. So what you could do, however, is maybe you sell that one international stock fund, but you buy back something that's very similar. It's not the exact same fund, but it follows a very similar strategy. And because it's following a similar strategy, it has high correlation to what you just sold. It might just be with a different money manager. And what you've done in this instance is you've maintained the structure of your portfolio, but you allowed yourself to tack on that loss to offset gains elsewhere in your portfolio. That's essentially it. And what it allows you to do is to continue to offset future gains, continue to postpone taxes, and ultimately just make more money through investments when done correctly. And never forget, when you lower your capital gains tax, you also lower your overall earned income. But the last few years have been volatile. COVID, the 2021 to 2022 bear market, and we've been doing a lot of harvesting for our clients. And I can actually see the benefits that are created, and I can see what happens when you harvest those losses. So what I'll kind of share with you is look into it. You don't necessarily need to do it, but look into the specifics. Talk to your advisor, talk to your CPA, see if it's applicable to your situation, because you might be leaving money on the table. But that about sums up today's conversation. And I'm going to end today's conversation by saying if you have questions, reach out. For the clients on the line, just know that you can always contact us at any point to rerun your planning, talk about strategies, loop us in with your CPA if you'd like to have a second set of ears within your meetings. Or if you just want to talk, we are always here. And for those that aren't clients, just know that our door is always open if you'd like to discuss what a relationship with us might look like, or to just springboard, to use this as a springboard for some of the questions you might have. So our contact information is on the screen. You can reach out to me directly, reach out to us on our website. We're here to help if we can help. But what I'm going to do now is open it up to questions. And for those that are watching the pre-recorded webinar, we do have to end the webinar now before the Q&A. So I'm going to end it. Reach out to me if you have any questions. And for those on the line, just hold tight for just a minute here.